Hi everyone, this is Professor Gallagher. In Chapter 5, we're going to talk about itemized deductions. Itemized deductions are only a tax benefit to the extent that they exceed the standard deduction that a taxpayer is eligible to claim on their tax return. So due to the recent tax law changes and the increase of the standard deduction, many people that on their prior tax returns were able to itemize deductions, it will no longer be advantageous for them to do so. Just as a review of the expanded tax formula, standard deductions are going to come into play under adjusted gross income. So once adjusted gross income has been calculated, the taxpayer will be able to subtract their standard deduction or itemized deduction. The first itemized deduction that we're going to talk about are deductible medical expenses. For 2018, medical expenses are going to be deductible for the extent that they exceed 7.5% of AGI. Taxpayers can deduct an itemized deduction for any medical expense, net of any insurance proceeds that are received for themselves, their spouse, and their dependents. The qualifying relationship of either spouse or dependents must exist on the date the expenses were incurred or paid. Taxpayers can deduct just about all medical expenses that are doctor prescribed. Expenses related to the maintenance of general health, like a gym membership or vitamins, are not usually deductible. A deduction may be claimed only for medical expenses that are paid during the taxable year, regardless of when the care was provided and regardless of the taxpayer's method of accounting. If a taxpayer has capital medical expenses, those are going to be deductible only to the extent that the expenditure exceeds the increase in fair market value of the property. For example, if a taxpayer was prescribed to have a pool put in their backyard for medical reasons, and the pool cost $20,000. However, if that increased the fair market value of their property by $18,000, then only $2,000 of that pool would be able to be deducted in the year that capital expense was incurred. Transportation costs for medical purposes are also deductible, and this can include items such as cab fare, bus, train fares, as well as expenses incurred using a personal vehicle. Long-term care insurance premiums are deductible, but the extent to which they are deductible is dependent on the taxpayer's age. So let's take a look at an example with deductible medical expenses. For 2018, Cynthia, who is single and 45 years of age, had AGI of $40,000. During the year, she incurred and paid the following medical expenses. She had doctors and dentist fees of $3,350, prescription medicines of $325, medical care insurance premiums of $380 that she paid for herself, long-term care insurance premiums of $730, and a hearing aid for $150. So what amount can Cynthia take as a medical deduction after the AGI limitation for her 2018 tax return? All of the expenses above would qualify as medical expenses, and they total $4,935. However, only expenses over 7.5% of AGI are going to qualify for a deduction. So Cynthia's AGI was 40,000, so we're going to multiply that times 7.5% to get 3,000. So only expenses over $3,000 are going to qualify for the deduction. So she has $4,935 in total deductions. So we're going to subtract the 7.5% of her AGI, which leaves us as $1,935 as deductible. Now we're going to move on to discuss deductible state and local taxes. There are four major categories of deductible taxes on individual returns. Those are personal property taxes, local real estate taxes, other state and local taxes, and foreign taxes. The taxes that most individuals deduct on Schedule A are their state and local income taxes and property taxes on real estate and personal property. The Tax Cuts and Jobs Act of 2017 limited the deduction for income, real estate, and other state and local taxes. Beginning in 2018, the limitation for the deductibility of all state and local taxes is $10,000 for married filing jointly and $5,000 for married filing separately. Real estate taxes are deductible in the calculation of federal taxable income. If the tax is paid on a personal use real estate, such as a principal residence, it is an itemized deduction on Schedule A. Personal property taxes paid on personal use assets, such as the family car, are deductible on Schedule A. For the property tax to be deductible, it must be based on the value of the property, it must be levied on personal property, and it must be imposed at a minimum on an annual basis. An individual can also deduct the amount of state income tax that is actually paid, whether this is from withholdings from paychecks, estimated taxes, or with the filing of the prior year's state tax return. However, if that taxpayer that deducts state income taxes receives a state refund in the following year for taxes that were deducted in a prior year, the refund would need to be included in taxable income in the year that that's received. This is the tax benefit rule. In 2018, taxpayers can elect to either take their itemized deductions for the amount of either state and local income taxes or state and local general sales tax. Since we don't have a state income tax in Florida, we will, for the most part, claim our sales taxes that are paid during the year. The taxpayers cannot claim both, so in most cases in Florida, our general sales tax is going to be more than any state and local income taxes that are paid. In general, taxpayers with states with an income tax would take the income tax deduction, while taxpayers in states like Florida with no income tax are going to take the sales tax deduction. The amount of the sales tax deduction can be used using the calculator that's on the IRS's website, and there's also instructions for that in the instructions for Schedule A. So the taxpayers can also include any large purchase items. So if you bought a car or a boat or a RV during the year, you can use that along with the deduction given to you on the IRS's website using the deduction calculator. So next, we're going to talk about foreign taxes. Taxpayers have the option of taking a credit for foreign taxes paid or deducting the taxes as an itemized deduction on Schedule A. In most cases, individual taxpayers are going to be better off using the credit rather than the deduction because the credit is a dollar for dollar reduction in taxes. And we will talk about the foreign income tax credit in our credits chapter later in the semester. So let's take a look at an example. Daryl, who had significant itemized deductions for 2018 and was eligible to use a Schedule A, purchased a new vehicle in 2018 for $40,000 with a state sales tax rate of 10%. The allocated deduction amount for other purchases made by Daryl throughout the year using the IRS state and local income tax tables would be $750. He also paid state income taxes of $4,500 for 2018. So we want to determine what Daryl's best option would be to maximize his tax savings. So in this case, his sales tax claim would be his $750 from the tax tables plus 10% of the automobile purchase of $40,000, which would give us a total sales tax claim of $4,750, which is more than that state income tax, the state income taxes that he paid. So he would claim the sales tax. So next we're going to talk about deductible interest. Interest that's paid on a loan to acquire a home or a home equity loan that's secured by a qualified residence is deductible up to certain limits. Beginning in 2018, the total amount that can be treated as acquisition indebtedness for any period cannot exceed $750,000. The interest on that amount, the $750, is the amount that would be deductible. Home acquisition and improvement indebtedness can be both mortgage loan principal and a home equity loan principal, as long as the home equity loan proceeds were used for the acquisition or improvement of the residence. So if you used a home equity loan to pay for a kid's college or to go on a vacation or to buy an RV, then those would not qualify for the interest deduction. There was also a court decision made on mortgage interest deduction limits that apply to unmarried co-owners of a home. The limits are imposed on a per taxpayer basis, not a per resident basis. So an unmarried couple that owns a property together would be subject to an interest deduction of interest on up to a $750,000 debt per individual. This would also apply to the home equity interest deduction limits as well. If points are incurred when a borrower closes on a mortgage, those points are deductible. Typically, taxpayers would deduct those rates over the term of the loan. However, in the law, there is an exemption for points that are paid in connection with a principal residence. So if it's a principal residence, those points that were paid for can be deducted in the year that loan closes. Investment interest is any interest that is paid or accrued on indebtedness of property allocated to property held for investment. The deduction of investment interest expense is limited to net investment income for the year. If the investment interest expense exceeds net investment income, the non-deductible excess expense is going to be carried forward to future years when net investment income is available. So let's go over a quick review. So for 2018, Thomas is a single parent and reported the following amounts related to his investments. He had net investment income of $7,000, interest expense on a loan to purchase stocks of $2,000, interest expense on funds borrowed in 2018 to purchase land for an investment of $6,000. What is the maximum amount that Thomas can deduct in 2018 as investment interest expense? Well, his deductible interest is going to be limited to his net investment income of $7,000, although he has incurred $8,000 worth of interest. So the $1,000 remaining will be carried over to the next year, and we will look at that point to see if he has net investment income to cover that remainder.